The seasoned billionaire investor Howard Marks, renowned for his decades of successful guidance at Oak Tree Capital, has warned about a significant sea change in the U.S. economy. His recent analysis highlights the potential end of abnormally low interest rates and a government burdened with debt. The implications for your investments are profound. Thoughts on sea change? Okay, firstly, let's talk about finding those hidden gems. Do you know how everyone always seems to be looking for them? I love seeing those super helpful websites that are entirely free to use. I may have stumbled across a real winner, Workerty. This website has it all. Whether you're a business owner, job seeker, or need extra cash, it can help. They've got free business listings, a jobs board, classified ads, and even a marketplace to sell stuff you don't want. It's convenient. Now, back to that economic sea change. Howard Marks isn't just the co-founder of Oak Tree Capital, one of the most significant investment firms handling distressed debt. This investor has an insane reputation for predicting colossal market swings. Marks has been in the game since the 1960s. Famous for investment memos and super detailed essays that break down the economy, they're so respected that even Warren Buffett swears by them. He thinks things are getting a lot tougher for businesses and investors. Remember those crazy low interest rates we've gotten used to? Well, they're not here to stay. Plus, the government is drowning in so much debt it's starting to feel scary. This combo is going to shake things up seriously. Like easy loans and those guaranteed investment wins we've been spoiled with, they might become more of a struggle, which will have a massive impact on how investors play the market.
In Powell's remarks on Monday, he said, we won't cut rates until we see we're making progress toward 2%. I thought that the word toward was very important. He didn't say until we're at 2%. The only thing I'm sure of is that if interest rates are higher, the people who invest in credit instruments, which is what we do, are buying in at higher yields and invariably will have higher returns than they have in the recent past. So today's rates are not high historically, but they're certainly higher than we had from 09 through 21.
Okay, I know this all sounds a bit scary, but here's the thing. Marks also thinks there's a silver lining. He says investors focusing on bonds and loans might be onto something in the strange new world. But of course, unless you're a total pro, that stuff can get confusing fast. Setting the scene. Let's first set the scene to fully understand Howard Marks' recent warnings about this sea change. Remember those crazy low interest rates we got spoiled with over the last 2 decades? He has some strong opinions about these. He doesn't consider the rates we're seeing now, around 5 to 5.5% high. He thinks they're pretty standard based on historical averages. He brings up his early career in the 1960s when interest rates bounced from a low of 4% to 20%. Compared to that, today seems downright stable. But why does he think we will stay within the ultra-low rates we got used to? Marks believes there are a few big reasons for this. First, the average period for interest rates, he argues, was back in the 1990s when rates were between 3 and 8%. Even more importantly, with inflation rearing its head again, he thinks the Fed will want to keep rates higher to prevent prices from soaring out of control. Plus, after this recent brush with inflation, he needs to convince the Fed is eager to rush back to super stimulative policies. All this adds up to what he sees as an average base rate of 2 to 4% in the coming years, a far cry from the near zero rates we had not so long ago. Of course, some people might argue differently, but that's Mark's bottom line. Easy money days might be over for a while. Now, you might be thinking, so what? What's the big deal? Well, Marks is famous for dissecting how interest rates affect the whole economy, and it's not good news for folks who got used to the good times. Low rates can pump up the economy, but too much of a good thing can cause serious problems, like out-of-control inflation. And when rates are rock bottom, investors start making riskier bets just to score decent returns. It's a recipe for lousy decision-making down the line. He describes it as a cycle. Low rates lead to easy money, then overconfidence, reckless investments, and eventual, painful losses. Then the whole thing reverses, with fear, tight credit, and the economy contracting. The scary thing is, he says the lessons we should learn from these easy money eras don't stick. Investors get caught up in the profits, the fear of missing out, and ignore the apparent risks.
So we had a low interest rate environment which made life very easy for borrowers, asset owners. It was easy to run a business. The economy was did well. We had the longest bull market in history, the longest economic recovery in history. We had very low incidence of default and bankruptcy. It was an easy world. And if you read articles about, for example, Silicon Valley Bank, they talk about the easy money environment. And the main point of sea change is we're no longer in an easy money environment.
Inflation is not under control. Marks thinks inflation might stick around for a bit longer than investors hoped. He doesn't see the Fed throwing a party and slashing rates anytime soon, especially not while those inflation numbers are still uncomfortably high. And here's where things get interesting. He points out that we've been spoiled with cheap goods from all over the world for decades, and that era might be fading fast. Remember those falling prices on everything we buy? Part of the reason for that was globalization. He thinks that if companies bring production and manufacturing closer to home, prices will be more challenging on the wallet. All this to say that those good old days of easy money and falling prices might be more of a historical chapter than our new normal. With significant change comes opportunity, right? He has been dissecting investment strategies his whole career, and boy, does he think this new landscape will demand a considerable rethink. That old approach of buying assets with borrowed money and just watching your investments effortlessly grow? Yeah, he's not convinced that's going to work so well anymore. Okay, so what are we supposed to do? Luckily, folks like Howard Marks are not about to leave us clueless. Let's discuss his insights on this sea change and how savvy investors might want to adapt. But before we dive back into those investment strategies, let's talk about a seriously excellent resource called Workerty. It's an entirely free website that's got it all. Whether you're looking to post job openings, advertise your business, promote products or services, or even find a buyer for those things collecting dust in your basement, Workerty makes it easy. They offer free business listings, classified ad space, and a marketplace for deals. It's your one-stop shop for getting things done. Plus, it works in the US, UK, and worldwide. Governments can't keep us aloft forever. Okay, so what about this whole government debt mess? Howard Marks is sounding the alarm, and the numbers are seriously eye-popping. The US government is raising a bill that makes your credit card statement look like a pocket change. They're so deep in the hole that he doesn't mince words. Governments can't keep us aloft forever. Think of it like this. The US government needs more money to keep things running smoothly. So what do? They keep printing more. It's a risky game because, as the old saying goes, there's no such thing as a free lunch. This debt pileup is a real problem. He worries it could get ugly.
Governments don't make money. They're not expected to make money, and they pay their debt by running the printing press. So that's a very different function.
And then they have the ability of extending the cycle at the same time. I think this is what I'm trying to get my head around. If they've absorbed basically the leverage that existed elsewhere, and they are less exposed to the challenges of companies that you would invest in, are you thinking of a much longer cycle as a consequence?
Well, I don't think governments can keep us aloft forever, you know. But and then the other question is, are the currencies acceptable to the world and at broad price? You know, an exchange rate is a price. The dollar euro exchange rate is the amount of dollars that people will pay to get a euro. And if that goes off the rails, then maybe they can't print as much or have other indigenous problems.
However, unlike Uncle Sam, who has a bottomless credit card limit, companies have been more cautious with borrowing. For this reason, Mark is pretty optimistic about credit markets. He points out that when interest rates are higher, those who make loans get paid more, meaning better returns for investors like him. But back to this government debt situation. Marks warns that this could seriously strain the whole system, and as an investor looking at those numbers, he's steering clear. At least with so much borrowing going on, the Fed is being forced to hike those interest rates to cool things down. And for folks looking for safe ways to grow their savings, it's about time accounts started paying a decent return. It's a small silver lining in this gloomy picture. Mark's advice. So, we know things are changing, but how does Howard Marks suggest we navigate this new investment reality? He's big on being a contrarian. This means zigging when the rest of the market zags. Most folks buy when things are booming and panic sell when times are tough. He sees this as a recipe for disaster. Instead, he's all about buying low and selling high. Obvious, right? But it takes guts to hold your nerve when everyone else is losing theirs. Think back to the chaos of 2008 when everyone was scrambling to dump their assets. That's when Marks and his firm, Oaktree, went shopping, scooping up what others were throwing away at fire sale prices. Speaking of nerves, he emphasizes the absolute importance of patience. Remember that bargain stock you scooped up? Don't stress if it doesn't soar the next day or even the following week. These things take time. Part of being a successful investor is having the patience to let your strategy play out. He's famously said, being too far ahead of your time is indistinguishable from being wrong. But how do we find those bargains in the first place? He stresses the need to understand the businesses or assets you're buying. He's not about mindlessly following trends or chasing hot stocks. Instead, he carefully studies companies and investments, ensuring they have sound fundamentals, a robust business model, and a management team that executes well. And here's another crucial idea. Even the most outstanding company can become a bad investment if you overpay for it. He loves his margin of safety, buying things for a lot less than they're worth. Imagine owning a share of a business for $50 when the industry is worth $100. That's your margin of safety. The cheaper the price, the higher the potential return and the lower the risk. It's common sense, yet many investors forget this when things overheated. He is super clear that there's no one-size-fits-all investment strategy. Every approach has limitations. The key is knowing when yours works best and when it won't. This means being willing to sit out those trends or opportunities that just don't fit your approach, which, let's face it, can be challenging when those around you seem to be making a killing. It takes discipline to say no to the flavor of the month. All of this would matter little with the final ingredient, psychology. Marks famously said, "Psychology matters more than market predictions." He stresses the danger of letting fear or greed get the better of you. This is where he thinks most investors go wrong. They panic when the market's dropping or pile in at the top. Mastering your emotions might be more challenging than learning finance. Okay, so let's bring it back to this sea change Marks is discussing. He thinks we need a mindset shift after decades of low interest rates and easy money. We can't count on the same things to work going forward. With that in mind, perhaps there's never been a better time to take a close look at Mark's philosophy. After all, he's navigated his firm through several market cycles and comes out stronger each time. So, while the investment world might feel uncertain, websites like Workity make it easier to hustle on the side or pursue entrepreneurial dreams. It's your one-stop shop for job postings, business listings, product sales, whatever you need to make those side projects work. Seriously, check it out. If you found this helpful, folks, remember to do all that good stuff. Like, subscribe, hit that notification bell, and leave a comment. I love hearing your thoughts on Howard Marks' strategy. And hey, if there's any other investing wisdom you're curious about, let me know. There's always more to learn in this crazy, exciting world of finance. Also, please share this video with anyone you think might find it valuable, and check out the next one in the series.